Hi everyone, welcome to my channel. If you're thinking of buying a house in Ireland but wondering how much the bank will actually lend you, in this video I'm going to break down exactly how mortgage borrowing works in Ireland, including the income limit, the deposit rules, real life examples, and common mistakes to avoid. So let's get started. The main rule: income multiples. This is also known as loan to income (LTI). In Ireland, mortgage borrowing is mainly based on income multiples. This income multiples is set by the Central Bank of Ireland. And generally, what this income multiple rules means is that you can borrow up to 4 times of your gross annual income simply by multiplying that. That means if you earn €50,000 a year, you may be able to borrow up to €200,000. If you and your partner earn €80,000 combined annual salary, you will be able to borrow up to €320,000. If you earn more, you have more borrowing power. Simply multiplying your annual gross income by 4, that is the maximum loan you'll be able to borrow towards your mortgage. Please note, this is just the maximum. It is not guaranteed. Banks will still look at your affordability. They will be looking at your spending habits and, of course, your job stability. Now, let's look at first-time buyers versus second-time buyers requirement. This is because who you are does make a big difference with regards to how much money you can borrow towards your mortgage. As a first-time buyer, you can borrow up to 4 times of your annual gross income. This is called loan to income (LTI). And as a first-time buyer, you need a minimum 10% deposit of the purchase price. Now, the loan to value or LTV limit in Ireland is 90%, meaning that you can be able to borrow up to 90% towards your mortgage. This is the maximum amount you can borrow from the bank, regardless of how much you're earning. You can't borrow more than the 90% of the purchase price of the property because you still need to bring 10% from your own savings. For second-time buyers, usually limit to 3.5 years of your annual gross income. Unlike the first-time buyers, you can get up to loan of up to 4 times of your annual gross income. If you're buying for second home, there is a limit there, and this is 3.5 years of your total income. And then you also need a 10% deposit towards the mortgage. However, this applies if you're selling your current home and you have a positive equity in that home. If you are in negative equity, say for example you are owing more than the worth or the value of the property, or you're not selling your current home, you might need a larger deposit, potentially 200% or even more. And you may even face a stricter rules from the bank, and so therefore it is best to check directly with your bank and present them with your situation. So if you're buying your first home in Ireland, generally you have more borrowing power and you need less cash upfront. Now, let's look at the deposit requirement. Your deposit directly affects the house price you can afford. For example, borrowing €320,000 as a first-time buyer, you will need at least €35,500 as a deposit If you add that to the 320,000 euros, this will give you the total purchase price of around 355,000 euros. If you need to buy a more expensive home and you are limited to the loan of 320,000 euros capacity, so you will only need to add more cash to your deposit, as there is no limit to how much you can add towards the purchase of a property. But remember, the deposit amount really does need to come from your genuine savings. It cannot be a loan. For example, you can't borrow a loan from bank towards the deposit of your home. You will be rejected for your mortgage application. Now, let's look at the affordability. This is the part that most people forget. Even if you qualify on the income level, the bank still asks one big question. And this question is, can you comfortably afford the repayment of your mortgage? How do they determine the answer to this question? They look at your monthly saving history. They look at your current rent repayment. They look at the other loans you may have. They look at your car finance, credit card, and so on and so forth. They also look at if you have any child care cost or if you're paying for crash or child maintenance. They also look at your lifestyle spendings. So it is important to consider all these factors, not just, for example, if you earning 100,000 a year, multiply by four, this gives you 400,000 euros. But that is from the loan to income standpoint. But from the affordability standpoint, if you then have a lot of loan, a lot of monthly commitment obligations, when the bank look at all this situation, you may still not qualify to get the entire loan of the four times of your annual gross income. Basically, as a rule of thumb, if you are not already saving or paying rent close to your official mortgage repayment, bank may reduce the amount you can borrow. Therefore, the loan to income at this point it's not guaranteed, so it is important that you're familiar with this affordability criteria. Now, the bank also stress test your mortgage. What this means is that they will check whether you could still afford your mortgage repayment if, for example, the interest rate rise by 2%. The This means your mortgage repayment will change from whatever you've been paying to higher monthly repayment. So they stress test your situation against this type of scenario to ensure that even if that happens, you can still be able to pay your mortgage comfortably. The bank will also stress test your financial situation. For example, if your financial situation changes, for example, if your salary gets reduced or your family size increases or anything happens, would you still be able to pay your mortgage comfortably? So even if your repayment looks fine today, the bank plans for tomorrow's risk and they try to put a mitigation against this risk to just to protect themselves, if I could say that. Now, let's look at the real life examples. Example one, a single first time buyer, income 45,000 euros, max mortgage request would be 180,000 euros. This person also needs a 10% deposit, which is 20,000 euros. In total, the person can purchase the house value 200,000 euros. Now, let's have a look at the another example. A couple, also first-time buyers, their combined salary is 90,000 euros. The max mortgage they could go for would be 360,000 euros. Now, they also need deposit of 10%, which is 40,000 euros. Now, the property they could buy would be 400,000 euros. If they need to buy a property higher than 400,000 euros, they will have to add more money into the deposit because they have hit the maximum loan capacity. From the loan to income standpoint, they can only get 360,000 euros from that salary. If you have more salary, more loan capacity. Now, here comes the $1 million question. Can you borrow more than four times of your income? Sometimes, yes, but in a very rare situation. Bank can offer exceptions to the rules, usually for the high earners or someone with a very strong saving history, someone with a low existing debt. These exceptions are very limited and it is very competitive and it's also not guaranteed. Now, the final tips to maximize your borrowing. To maximize how much you can borrow, you should save consistently. You should clear any unnecessary debt. You should avoid missed payments. You should keep your spending stable before applying for mortgage and talk to a broker early so that you can know your current situation and plan for the eventualities before you apply for your mortgage. This is because even a small change can mean a ten of thousands more in your borrowing power. If you have some small loan here and there, try to close them or to consolidate the loan, and then that could give you a very strong borrowing power. And then another thing I like to say to you is that the banks or the lenders they don't like seeing any traces of gambling or any form of bettings in your account history. So even though I'm not your personal finance advisor, but then I just want to tell you if you are someone who play bettings or you gamble or you put a bet or something, I encourage you to to maybe try to withdraw the money from your account and pay for your the game ticket or your lotto by cash. If you do this, in your electronic transaction, the bank sees this and it's gonna be a red flag for your mortgage application. Now, if you found this video helpful, hit the like button, subscribe to my channel. This means a lot to me and it helped me and it encouraged me to make videos like this. And you can also forward this video to anyone you think is, want to buy a house in Ireland or who is just trying to understand what the mortgage process looks like in Ireland. Also, let me know in the comment section if you are buying your house in Ireland for the first time or if this is your second home. You can maybe share your general knowledge or experience with regards to mortgage, the loan to income, or the affordability, or anything at all you want to chip in to help us grow our community. Thank you very much for watching, and I wish you a very best of luck in your mortgage journey. And see you in my next video. Bye.